Welcome you all once again to this section. So let's look at the question 3. It's called Impuntu. Question 3, Impuntu. We will look at the question without footnotes. And right after that question, we will start the footnote. For that question, I'll be going a bit faster than the previous. Good. So take note. Great. Now let's go straight to question 3. So this is the question. We are solving this without the footnotes. So that you tell me where each of the item will be treated and then or will be recognized. Good. So as usual, the financial statement preparation, the requirement will be 3. First, prepare the comprehensive income, and then the changes in equity and the financial position as at that date. So we will do the comprehensive income and the statement of financial position, then together with the changes in equity. Now, good. So let's see. Now let's come through the trial balance. So when we mention the item, we will state where we will organize this transaction. So first, the capital. So that will go to changes in equity, right? At the same time, the financial position, equity section under equity. Income surplus, the same place. Change in equity and the financial position. Furniture and fittings, it will go to the PP workings or the PP schedule. Good. Cash and bank balances, that's the current asset, right? Good. Cost of sales, it will go to the profit or loss. That's right after sales revenue. Good. Then stock, that is the inventory, the closing balance. Yes, the closing balance of the goods. That's the current asset. Then 18% debentures. 18% debentures. That is the non-current liability. Now here the finance cost will be what? 18% on what? The 100,000. That will give us 18,000. So that's the finance cost on this value. Then you check whether they've paid this amount, this 18,000, whether they've paid it. So you can see the debenture interest here, 14,000. So that means out of the 18,000, they've paid what? 14. Everything here, there's no paid here, right? But still, it represents debenture interest paid, 14,000. Good. So out of the 18, they've paid what? 14. So they are owing, right? 4,000. Good. So that will be a current liability. Long-term investment, that's non-current assets. Provision for depreciation, that is accumulated depreciation. That is what we are going to subtract from where? From the cost of the non-current asset. So furniture and fittings is 80,000. Motor vehicle is what? 50,000. Then sales 315,000. That's the sales revenue. Director's fee 9,000. Auditor's fee, audit expense. All these three, they are what? They are operating expenses. Proceeds from sale of fittings. For now, we will classify it as what? We will classify it as other income, but it is a profit on the sale of the PP. Good. Because we are going to touch anything in a footnote, we will classify the 3,000 as other income. Uh-huh. Good. Provision for doubtful debts. That is 200. So this, we will take it off from where? The receivable or the debtors. You can see trade debtors and creditors. So debtor is 6,000, creditors are 7,000. So you will take the 200 here from the 6,000, and then we will show it in the what? The financial position, current assets. Capital surplus, that's 12,800. That is the revaluation reserve or revaluation surplus. They mean the same. So they go to where? Changes in equity and then the financial position. They are equity item. Then equipment cost 45 million. But the current amount is what? 30 million. That means this 30 million, it means that they've subtracted the accumulated depreciation from the 45 before they arrive at the 30. So in short, the accumulated depreciation is what? Is 15 million, which are they have subtracted from where? The 45 before arriving at what? The 30,000. Sorry, the 30 million. Admin expenses 33. Interim dividend paid 2,000. Investment income 24,000. Investment income will go to where? Other income. Debenture interest, we've talked about it. Tax paid for 2018. In fact, for now, tax, I'll do all that section for you. So for tax, I'll do it till we start. Provision for deferred tax, the same. It's a non-current liability. So we just add it to non-current liability. We are done. In fact, if we use voice to finish this question, if we use our voice to solve the question. So now let's back with illustration. We will be very fast, extremely. Yeah, good. So now let's go to the board and now let's start the game. So the name of the company, Impuntio Limited, and then the year, reporting year, can check on the trial balance, 31st December 2018. Good. We are paying the income, comprehensive income for the year ended 31st December 2018. Good. So let's see. Let me do the demarcation here. Good. So we start like this. That examiner that we are preparing it for what? Input you. So input you. Let me check. Good. Input you limited. So statement of comprehensive income. So statement of what? Comprehensive income. Comprehensive income for the year ended 31st December 2018. Then you check the question whether the currency given to us is in thousands or millions. So let's go and check. Wow, so it's in what? Thousand. Ghana cedis is in thousands. So the protocol. So I write the Ghana cedi here. Erase the three zeros. You are done. These are the three protocols. The requirements, the, sorry, the name of the company, that's one. The requirements and the reporting currency. So one, two, three. Good. So there are three ticks for you. Good. The name of the company first, the requirements, and the reporting currency. So I'll start. In this question, when we were scanning through, I saw sales. So I write sales here. So the figure was 315,000. I'll continue the game. Cost of sales. So cost of sales. For that one, let's go and pick it. So cost of sales from the question, that is 45,000 or 360, no, 45. Yeah, so cost of sales was 45,000. So 45,000. Good. Now what to be the gross profits? That is the direct profits. The accounting term for the direct profit is called a gross profit. Good. So let's see. That where's my calculator? Good. So 315 less 45. That's 270,000. So that's the gross profits. So you put it down. Perfect. So where do you go to? Yes, I like that. In fact, you had it correct. That's what operating expenses. So operating expenses. The operating expenses, we said that we have to go and do one workings, assemble all the operating expenses together in one single workings and bring them here. So I'll tell the examiner that please relax. Go to workings number one. You go and see the figure there. So I'll pause and go and do the workings. If I go and then we cannot be able to probably find it or calculate it, leave it, go to the next one, the one that you can do. Great. So that is it. So that is it. Now let's go to the workings. So let's do the workings here. Just that we taking them off. So workings one deals with what? Operating expenses. All right, the operating expenses. Operating expenses. Good. Then I'll go to the question. I'll list all the operating expenses in the question. To avoid oversights, please start from the very first item to the very last item. Scan. So this is operating expense. No. Income stated capital. No. Income surplus. No. 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 Like that. If you use your eyes to point on them, in fact, the arrangement, sometimes we will scatter them through or spread them through the question. So if you start by one after the other, to help you not to leave any of them out. Good. Now let's see. Provision for depreciation, no. Long-term investment, no. Sales, no. Director's fee, yeah. So director's fee, auditor's fee, and audit expense, so these three. So 965. Director's fee, auditor's fee, and audit expenses. They are operating expenses. So let's go. First, director's fee. Here too, don't forget your currency. Three zeros. Good. So director's fee, it was 9,000. Then auditor's fee was also 6,000. Then audit expenses was also 500. So that's for now. Put them down. Then you go back again. Let's see. Okay, 965. Good. Proceed from sale of fittings. Nope. Provision for bad debts. Nope. Capital surplus. Nope. Motor vehicles. Nope. Wow, look at where admin is. Administrative expenses. Administrative expenses, 33,000. Yep. So we need that one. Let's go and add it to it. So admin expenses. Admin expenses. Good. That will be 33. So in exams, try and do this one first before you tackle any item in the footnotes. Why? Because they are free marks. Free that you don't need any adjustments. Good. Now let's continue the game. Let's scan and then assign all the operating expenses together. Investment income, no. Debenture interest, no. Tax, no. Deferred tax, no. So we are done with the operating expenses. Then you sum them up. Good. So 9,000 plus 6,000, that's 15,000 plus 33. That'll give us 48. So 48,500. Good. So 48,500. That is it. So you come here, then write it here, 48,500. How we get it? Good. Then you analyze it. You take it off, then the answer becomes what? The operating profit. The operating profit. So we call this one operating what? Profit. So operating profit. That will give us 221,500. So 221,500. Good. Now from the operating profits, let me go to and you add what? Your other income. Good. So let's do the other income. We said that the other income, they are income that you earn, which are side or apart from your core activity, the ordinary course of business. So any income that you earn aside what your core activity. So example include investment income, rental received, interest or dividend received, sale, profit on sale of PPE, profit on sale of what? PPE. So let's go to the question and see if this item they are there. It also includes rental income and then fair value gain on what? Investment property. Fair value gain on what? Investment property. That is it. Good. Now let's go and scan through. and see if we can find some of this in. Okay, in fact, that one to say capital, no, 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 no. Good, there's one here. Sale of fittings, the proceed. Please, in fact, the other income section is the profit, not the proceed itself. But here, because we are not touching anything in the footnotes, then we have to use that figure. So it means that it's after we touch the footnotes, the or after we consider the issues in the footnotes, that figure will change. So we will calculate the actual profit, not necessarily the proceeds. Good. Great. So another one to or the other income, say include investment income. Wow, so there's investment income here, 24,000. So therefore, the other income in this trial balance, not this question, this trial balance is worth 3,000. Some to be in the footnotes, but now we are not tackle any figure in the footnotes. We are just considering what the trial balance. Then we start the footnotes one after the other. Good. So we do workings and add this 3,000 to this 24, get 27,000. Then we are done with the other income. So workings number two, all right here, other income. Good. So I'll place it here and I'll start. Proceeds. Proceeds from where? Sale of property. Is it fittings? Let me go and then pick it up. Proceed from sale of fittings, right? Okay, so sale of fittings. Wow. It's not good there. So it's not good there. Let me do my thing. I shortcut it. Please, examine shortcut it. So proceeds from sale. Good. Don't forget your currency in thousands. Sorry. Okay. So bring the three zeros here. Proceed for 3,000. Then investment income 24,000. Investment was income 24,000. Putting everything together, what do we get? Putting everything together, we have 27,000. Good. So that is it. Can we copy the workings for me? Then I'll take that section off. Thank you. Give me a. So 27,000 will be here. Don't forget to refer the examiner that you should go and then mark this at the workings number two. So workings number what? Two. Workings number two. Good. Then we put this together. So the operating profit plus the other income will give us profit before interest and tax. So profit before interest and tax. Good. Profit before interest. So it will be 194,500. So that's the profit before interest and tax. Good. Okay, so it's an income. So we need to do what? Add. So therefore, we will get 248,500. Good. So that is it. So this profit is before what? Interest and tax. Or this profit is before Odoko and Malam Junction. So where are you now? Or where's your next destination? You are going to Odoko. Good. So interest, we will call it what? Finance cost. So finance cost. And then we will do workings on it and then bring it in here. It includes all interest that you are paying on your debts or facilities. So interest on debenture, interest on loan, interest on bank overdrafts or bank interest. Or in reality, it includes administrative charges on facilities. It's also a finance cost. Good. Now let's go to the question. In this question, we only have one. That's the interest on the debentures. So 18% debenture. 18% debenture. Here, once there's 18% in a question, we have to calculate by ourselves by striking it on what? 18% on the 100,000. That will give us 18,000. If this 18% is not in a question, you cannot guess your own percentage. No. Then that one, the debenture interest that you see here will be the one we are going to key it in. So if this 18% is not here, or it's not in a question, it is not in a footnote anywhere, then we will just select what? This debenture, this interest, 14,000 as the finance cost. But once they've informed us that the interest on that facility is what? 18%, then we can calculate the interest by ourselves to determine what they've incurred for the period. So show working and then tell us. So it will be something like, so you open your bracket nicely, 18% times what? 100,000, and that'll give us 18,000. Then you do it like this. Okay, I'll continue the other section from the other angle. So let me go down small like this. Good. So that's 18,000. Then they've paid 14, so they are owing what? 4,000. That is it. Now let's continue taking. I want to take the working section of good. So that we will continue from there. Good. Now what we will do is this. Taking this from this, you get any answer for me? 248,500 less the finance cost. So we will get good. I like that. That's great. So that will give us 230,500, right? 230,500. Agreed. Good. 230,500. 230,500. What will be the name are we going to call that figure? We call it what? Profit before tax. We've already taken what? Interest out. Good. So profit before tax. So profit before tax. Good. Then 230,500. So if this profit is before tax, what will be the next junction, or what will be the next item that we have to treat? So that is the tax, right? Good. So we'll do the tax. So income tax expense. This section, that one I will handle. Income tax expense. So let's go to the question. They pay a tax of 3,000. So tax paid for the year, 3,000. So I'll bring it there. Don't need to worry about the tax section. Good. When we start the footnotes, we find. Meanwhile, there was what? Provision for deferred tax. For that one, it's a non-current liability. Good. Go to the conceptual framework. When we were dealing with the elements of the financial statement, one of them is what? No, liabilities. And then we look at the types. We said non-current liabilities. We gave example of non-current liabilities, and deferred tax was parts. So this is a non-current liability. Good. So you are going to pick this 3,000 as the income tax expense. Good. That's 3,000. So therefore, profit before tax, antipart will be 227,500. That's antipart. So we call it profit after tax. Please, no shortcut in exams. No shortcut in exams. So that is it. If for the profit and loss section we are done, but for the comprehensive income, we can move further and tell the examiner that OCI, other comprehensive income, please no shortcut to these two. Write them in full. So other comprehensive income is dash. So therefore, total comprehensive income will be will still be 227500. That is it. So that is how we are going to do that. And then fine. So the OCI is dash because you're not tackle any item in the footnotes, because the OCI will be given to you in the footnotes. Okay, good. Now we are done with the profit or loss. So let's go to the financial position. In fact, I'll do the changes in equity here nicely. I'll do the changes in equity before I go and do the financial position for this question. The changes in equity. Changes in equity. So still, the three protocols must be adhered to. Now let's see. We'll still write the name of the company in Puntio Limit. I want to do it here. I was going to do it here. Wish I can do it here. Okay, I'll do it there. I'll do that one here. I'll do it here. Good. Can I take this section off to do the statement of changes in equity? So, okay, that's fine. So, go in, gone. So that is the end of the profit or loss or the comprehensive income. Now the changes in equity to the three protocols must be there. So first, input limited. Second, statement of what changes in equity. In equity for the year ended 31st December 2018. For that one, then you relax, go to the question and scan through the equity item of the question. So the equity item in this question, we have what? Stated capital 1, income surplus 2, then capital surplus 3. So only 3 equity items. Good. Kindly visit the conceptual framework to look for the equity items or the previous lecture video. Good. So there are 3: stated capital, income surplus, and capital surplus. So I'll start like this. Alright, the stated capital here. So stated what? Capital. Income what? Surplus. Capital what? Surplus. And then bring the total. How we get it. Then don't forget your currency, the 3 protocols. Good. So this is how to look like. Then the open balances. So let's write open balance. You go to the trial balance. All the value that you see for these people, they are the open balance, except otherwise stated in the footnotes. Not always. That figures will be what? Open balances. Uh-huh. So you should take note. But there are no footnotes telling us that that's not the open balance. Then we assume that that's the open balance. Let me take it again. If there are no footnotes in the question stating that the balance that you see, we have adjusted it. Okay, so that means that's not the open balance. If there's nothing like that in the question, oh, then carry the balances as what? As open balance. Now let's go to the trial balance. Stated capital is what? 300,000. Income support is 40,000. So 300,000, 40,000. 30,000, 40,000. And then left with the capital surplus. Let's go and pick the capital surplus. Capital surplus is what? 12,800. So 12,800. Putting these 3 together, so that's 340. 52, right? So 352,800. So that's the total. Then you ask these questions. 1, have they issued shares in the question? If there was issue of shares, it will affect the stated capital. So we record it here. For this question, there's no issue of shares, so because you're not tackling the footnote. Then the next item, profit after tax, antipart. So bring profit after tax here. So the profit after tax must come under the income surplus. We had what? This is it, 227,500. So that's the profit after tax. So 227,500. Then you place the same thing under the total section. So 227,500. Can make here dash dash to affect only this section. Good. Now the next item, you check if there was dividend in your question. Dividend. So dividend in your question. So let's see if there's dividend. So please, it means that here, if your profit after tax is wrong, coming from here, if it's wrong, it will follow us. That will mean to get it wrong there. But don't worry, the entries, this one will mark correct for you. This one will mark wrong. Maybe the next one I'm going to pick correct in that order. So take notes. Don't worry about the final answer. Now the dividend. You pay the interim dividend of what? 2,000. So interim dividend. So dividend of what? 2,000. So you record it here and you put it in brackets. Dash, dash. Put the same 2,000 here in brackets. Then that's all. If there's revaluation, so come here. If there's any error or mistake that will affect this opening balance, you will do that according to IAS 8. Good. If there's any error or mistake or adjustment, which is as a result of what? Last year or last 2 years issue, then we have to adjust the opening balance. Good. That is it. Now this question, that's all. So you underline it. That's the changes in equity. Double underline it like this. Then call it closing balance. Closing what? Balance. In this class, balance carry down and carry forward is what? Forbidden or bound here. Bound them here. You are using open balance and closing balance instead. So you add all, get 300,000. You add all, you get 5. So 265,000, right? 500. You add all, you get 12,800. In fact, you add all Sunday unless you use calculator. So let's see. So 352 2222. Okay, this one needs to give her 500, right? Any help? 265. Wait. Mm-hmm. 578,300. Agreed. So 578,300. Good. 300. So that's the total. So that's the end of what? Changes in equity. When we go to the financial position and we need stated capital, we have to pick this figure. So all this closing balance is going to where? The financial position. All these ones are going to where? Statement of what? Financial position. So when you go to the financial position and you mention stated capital, record 300. You mention income surplus, record this figure. Capital surplus, this figure. That's for now. I hope you get it. Good. So that is it. Okay. Now let's see. Let's continue with the statement of the financial position. So let's prepare the statement of what? The financial position. So that one too, I'll start from here and then come and then end here. Good. Then I'll be cleaning this one too. So I'll take them off. I'll take them off very soon. Now let's continue the game. Let's continue the game. Let's continue the game. Let's continue the game. And then you will be fine. the three protocols we have to adhere to it. The name of the company. So here to Impuntio Limited. So still Impuntio Limited. Impuntio Limited. Good. Then statement of financial position. Financial position as at 31st December 2018. Good. As at 31st December 2018. Then you put it there nicely. Then you underline it. Don't forget your currency. Three zeros. Then you start. You are using this method. Asset is equal to equity plus liability. All your asset one side, both non-current and what? Current. Then you relax. Then you cross what? River Jordan. Go to the other side of the river. Start with your equity. Relax. Then beside it, place your what? Your liability down to both non-current and current. You are done. So that will be the game. Good. Now let's go to the assets. Let's go to the assets. So non-current asset first. Non-current what? Assets. That is the first thing you have to remember is what? The PPE. Property, plant, and equipment. No shortcuts. So property, plant, and what? Equipment. Let us know that we do the workings. So let's do that working here quickly, and then we send it in. Let's do that working where? Here. And then let's send it in. So that is good. Okay. So can I take this section of I did a working here? Oh, I've been there. Marcation. So the working will be here. That's workings number. If we should continue the workings, it was number. The last working number was 2, right? Last working number was 2. So this will be what? Workings 3. Good. So I already working 3 here. And call it PPE schedule. So property, plants, and what? Equipment. Line it. Don't forget your currency. So for that one, you're using this style. Bring the cost here. Even though after IS 16, when you treat IS 16, I'll bring item here. Bring another. We'll have the full picture after the IS 16. I will change the format again after the IS 16 and you'll be fine. Good. So the cost of the assets in the accumulated, in fact, cost of valuation. Yes, sometimes they revalue the assets. So accumulated what? Depreciation, almighty carrying amount or net book value. And you bring your currency 3 zeros, 3 zeros, 3 zeros. You start here till you go to the question and you list all the tangible non-current assets, the PP. So here to you start from top to down. Then you are done. Good. So that is it. Now let's go to the question to pick the PPs from the question. Good. Okay. So from the question, the first PP is what? F and F, furniture and fittings, 120. Furniture and fittings, 120. So furniture and fittings, 120. Good. So furniture and what? Fittings, 120. Good. Why is the other side? The figures are too small over there. Now let's continue the game. It's 120. Cash no. Provision for depreciation. Okay, that's good. Furniture and fittings is what? 80,000. So it will be 80,000. Now let's go and pick the next assets. The next asset is motor vehicle. Just that this figure is for what? Is for the accumulated depreciation. Because this here, the provision for depreciation refers to these two items. That's why they've given us what? A column. But motor vehicle, look at where the cost is. Motor vehicle, this is the cost. It's also what? 120. And then accumulated depreciation is what? 50,000. So motor vehicle, still 120,000. And then 50,000. Then let's go and pick the last assets. The last assets. That's the equipment. Cost is 45. The accumulated depreciation is 15. They've already subtracted and they had what? 30. When you do this, the cost is 45, carrying amount is 30. So automatically accumulated depreciation is what? 15. So that one, right? Equipment here. You can decide to produce the 30,000 here as a carrying amount, then you leave the rest right here for teaching purposes. I'll bring all of them 45,000. Then you put all the accumulated depreciation in brackets. Then you subtract. So this will give us 40,000. This will give us 70,000. That will give us 70,000. You put all of them together. Then we are done. So 40 plus 70 plus what? 30. That'll give us 100 and what? 40,000. But here's 240 to 85,000. Then in fact here is 60, 140, so 145,000. Agreed. We put this one in brackets. So you come here and please refer the examiner that you should go to workings number 3, you will see this answer there. We had 140,000. So I write the 140,000 here, and then we are done. So it's 140,000. Good. Now let's see. Let's continue the game. Then we say after PPE, you have with three items. What are they? One, investment property, intangible assets, and then long-term investments. So let's see this question. Which of them do you have? At least aside the PPE, there must be one of these three items. At least. So I can see long-term investment here, 150. So I'll send it there. Long-term investment, 150. So long-term, long-term investment, 150,000. Good. I'll put it there, 150,000. Long-term investment. Then, fact, if there are no intangible assets, we are done with the question. So it's country again, there are intangible assets, no intangible, no investment property. So that's the end of non-current assets. We are done. Sum them up, get to 90,000. So the total non-current asset is what? 200 and what? 90,000. Total non-current asset is 200 and what? 90,000. We are done. Underline it once and then take a short rest just for a second or two. Then you come to the current assets. So current what? Assets. Current assets. Good. The current assets, it start from the inventory. Just like this question, the examiner call it what? Stock. So you have to also write what? Stock. So why are you stock? Why are you? Stock is here. 34,000. Good. So stock, I'll give her 34,000. Then we go to receivable or data. That's 6,000. But we said that there was provision for bad and doubtful debts. So the provision, the balance must be subtracted from where? Debtors. We will explain why we are doing that. So 6,000 less 200, that'll give us 5,800. So you write trade data or trade debtors. Open your bracket. Tell the examiner that is 6,000 less 200. Close the brackets, but nobody will. Let me squeeze it so that I need more space. So trade debtors. 6,000 less 200. That'll give us 5,800. Good. Then from trade debtors, you go to cash in hand and cash at the bank, or cash and cash what? Equivalent. Cash and cash equivalents. Good. Now let's see if you have cash and cash equivalent. I can see cash and bank balances 360,000. So I'll go in for that one too. 300 and what? 60,000. Wow. So 360,000. Let's see. So cash and bank balances. So cash and bank balance 360,000. So we are done with the current assets. We are done with the current assets. So we sum it up like this, then we get the total assets. For the sum, we get the total current assets before we calculate what the total assets. Good. So now let's sum up together. 34 plus 5,800. That's 39,800 plus 360,000. So that will give us so 399,800. Agreed. Confirm for me. Kindly confirm for me. Okay. So that's the current asset. Then you write total assets. Total assets will be double underline because that's the River Jordan. What do? We will put together total asset, total non-current asset plus the current. So let's make it AB. So A and then B. Putting these two together. So what do we get when we put these two together? So when you put the two together, I like the answer. So 399 true. Okay, that's great. Now putting the two together, 689,800. So 689,800. I like that. That's the total assets. Good. Now let me go to the other side to continue the game. I'll continue here. So kindly copy this in for me. Copy this, just this section. So I'll take that section off. Good. Section off. Good. So going first. Boom. We're needing these figures. That's why I'm not doing that one. We're needing that. So we are still using this as it's called equity plus liabilities. Asset is equal to equity plus the liabilities. We are done with the assets. We are now going to the other side of the river to add equity and liability. This continuation, but the space here is not enough, so I want to do it at the here. Good. So exam to be a one vertical presentation. Good. So let me continue here. So I'll go to equity. Let me write the equity here. So equity. So equity. So equity, you are going to list the equity items. If you have already prepared your changes in equity, don't need to worry. You have to bring the items there. If I have not prepared the changes in equity to you, so don't need to worry. What you have to do is go to the question and pick the equity items. Good. So for this question, we saw three items. They are stated capital, stated capital, continuation, fact, it was 300,000. So we got 300,000. This figure. But if you have not prepared the changes in equity, don't need to worry. Go to the question and pick it from the question. So you go to the question, it's 300,000 here, then you pick it. But if you have prepared the changes in equity, just pick it from here. Then we go to the income surplus. Income surplus. If I prepare this, you will just have to bring it here, 265,500. Just have to lift it from here to that section. Assuming that it's not prepared the changes in equity, what do? Open your brackets, open balance, plus profit after tax, plus dividend. You are done. To give you this answer, that's a short presentation that you can do. Don't forget, if there's any error or adjustment, you adjust it in there, then you are done. So let's assume that we've not prepared the changes in equity. So I'll go to the question, what is the open balance of the income surplus? It's 40,000. Good, that's all what we need. Open balance of the income surplus is 40,000. So here, I want to show the working something like this. So the 40,000 plus the profit after tax, that's 227,500 less dividend of what? 2,000. So this is the workings for this figure, and then you are done. Good. So that is it. Now let's continue the game. Then we got the capital surplus for the same show. But if I don't scale this thing, I'm not go there. So capital surplus, but we have 12,800. One good news about the change in equity is that when you are done, this answer, if it's correct, just record the same answer in here. That's one good news about change in equity. But if you happen that it's wrong too, it will also follow you. Now I can gently take off these ones from there because we have used them. They are coming from the changes in equity. Good. Now we are continuing the game. We are done with equity, so let's liability. Let's go to non-current liability. Non-current liability, we start from where? The long-term debts. Let's go to the question. If you do have long-term debt in there, yes, you have 18% debenture, which is 100,000. And then the last item, deferred tax 400. So these are the two items. Non-current liabilities 2. So 18% debenture. So 100,000. Then provision for deferred tax. So deferred tax. And so it's what? 400. Yes, for 400. So the total non-current liability is what? Is 100,000 and 400. Then you come to current liabilities. So current liabilities. How we get it? The trade payable or the creditors, and then any expenses that they are owing. So let's go. Creditors is 7,100. And then let's see. So creditors 7,100. Please, is there any other item we have to keep it in? And the person that will tell me will be the accounting cracker of the night. Accounting cracker of the night. 11 with one item. to form part of the current liabilities. We mentioned it at the inception of the class. I want to be sure. I want to know that. Oh, yes. Yeah, that's true. Someone have mentioned it. Yes. Privately, someone have mentioned it. That's good. Any other? I'm waiting for your own too. Okay. Still waiting for your own too. Okay. Interest in arrears. Good. So interest owing. So interest was owing. You open your brackets. They're supposed to pay 18, but they paid only 14. So they are owing what? 4,000. So therefore, the current liability will be what? 11,100. So that's the total current liability. Here, and from here, we are ending the game. So first, you have to get a total liability, but that one is optional. That one is what? Optional. Good. So you get a total liability. That section I can name it as what? Optional. So total liability will be non-current plus what? Current. Good. So adding these two together is what? Optional. So total liability will be 100, 400, 500 and 400. 100,000, 400 plus 11, 100. So that will give us 111,500. So that's the total liability. So total liability. Liability. How we get it? Total liability. So that's that one. Total liabilities. And we get a total equity and liabilities. Total equity and liabilities. So that one we add this plus what? The equity together. Is what are we getting? The total equity and what? Liabilities. Liabilities. In fact, okay, we get 689,800. Good. We get 689,800. Good. So that would be the answer. And that's the end of the game. And this question marks the end of the trial balance solving, meaning we are now going to pick any question that we pick from here, we will tackle the footnotes fully. So now the empty section, we are using these two questions to end the empty section where we tackle only the issues in the trial balance. So this is how we work for it. Now, if you do have any question, kindly let me know. Okay, great. So now let's look at the issues that make the preparation of the financial statements a bit terrible or difficult. That's the footnote. So I'll consider that. But before that, I want to work out the cost of sales. Yes, some few issues with the cost of sales. Now, suppose you take all the items one after the other. But for some of them, you know them already. For instance, sales. During the conceptual section or conceptual framework, we said that sales refers to what? Refers to the direct income. Income from where? Ordinary cost of activity. It must be the one that coming from what you do in your core activity. Good. So the other revenue must be part of what? Other income. Now I'll go to cost of sales. Then I'll start the footnote. Cost of sales calculation. Cost of sales. Now with cost of sales, this is how we calculate what cost of sales. The cost of sales you see in the question, it passed through the same procedure. You start with your open balance of inventory. You say open what? Inventory. So much. Add your purchases to it. So much. Less your closing inventory. Less what? Closing inventory. So much. This is cost of sales, but this cost of sales is incomplete. This cost of sales what is incomplete. So in the trial balance, the cost of sales figure that you see, the examiner have gone through this to calculate it for you. So it means that sometimes the examiner will ask you to calculate it by yourself. So let's see. Now, open inventory is the beginning balance of the goods or the inventory that you have. That's the stock. Purchases during the year, additions that you made. Leftover. So the closing inventory, let's get a picture. Get it. Then you add other direct cost to it. Add what? Other cost or other direct cost. They include and then any adjustments. One, they include what? Depreciation. Now this depreciation, let the examiner inform you that depreciation must be charged to cost of sales. If they don't inform you, then you have two options. Either you treat it as cost of sales or operating expenses. So depreciation can be cost of sales, can be treated as what cost of sales or operating expenses. Now, if the depreciation that on the assets, you can decide, okay, for plants, because they are using a plant for production, it's a direct cost. So I'll add it to what the cost of sales. But for office building or admin, general administrative building, such depreciation on that building must be what treated as operating expenses. But in your case, they will inform you that okay, depreciation must be treated as what cost of sales. So come and add to cost of sales. If they don't tell you anything, you have two what options. Either you treat it as what cost of sales or operating expenses. You can make a decision that okay, all my depreciation, if they don't tell me it's cost of sales, unless otherwise stated. Or I'll send to operating expenses unless otherwise stated. So that's fine. So depreciation. Don't need to worry about depreciation. We will calculate. We will go through all of them. This will be in a footnote. Then inventory written down. Inventory written down. Inventory written down. We look at it. You don't worry about it at all. That is IAS2 when we start the standard. And what IAS2. Good. And the IAS2. Then errors. Errors. Maybe the examiner will inform you that this cost of sales that you see, they have mistakenly charged certain items to it. They have wrongly added certain figure to it, and they've informed you. What do? Reverse it. Or they have mistakenly subtracted certain figure. Reverse it. So if they have wrongly added, what do? You reverse it by what? Taking it out. Or if they have wrongly what? Subtracted. Reverse it by what? Adding it back. So how we get it? So top it up. When you do all this, this is the final cost of sales. So it means that the cost of sales that you see in a trial balance can change after going through this. Most questions, when you see cost of sales in the trial balance, this is the figure. So this is the one that normally is stated in the trial balance with errors. They will not adjust it with the depreciation. No, they don't know do that. Good. So the another you have, you go to one question, either question 5 or question 6 or question 11. For last two settings, it was question 11. Then you try and do just that one. You are just calculating the cost of goods for me. This cost of goods. Good. So let me see if I can get that question. And then last sentence question to the same thing. Yes, last sentence question, the same thing. So you look out for that one too for me. And then you calculate the cost of, so this very cost of this very one. Open inventory pages, left is inventory. You are done. Let's see. One of these questions contains what we are talking about here. That's question number yeah, the question after this. Good. Question after this. So okay, let's see this one. No, it's not this. Good, in this one. So this question, that's question 8. Frafraha Limited. So question 8. Now the issue is this. In a trial balance, there are some two people, they agree, they move together. So in a trial balance, if you see purchases in a trial balance, purchases move with what? Open inventory. Definitely, there must be inventory in a trial balance, either the closing inventory or the what? The open inventory. It normally depends on whether they've given you the purchases or the cost of sales. In short, if you see purchases in the trial balance, that means the inventory figure given to you is what? The open inventory. Let me repeat. So in a 9 trial balance like this, and I inform you purchases, maybe 300. Inventory, 200. This inventory, we just said inventory, no closing, not open, no date attached to it. Once there's purchases in a trial balance, this inventory becomes what? Open. So anywhere you see purchases in a trial balance and there's inventory in a trial balance, that inventory is what? Open. Because purchases and open inventory, they are twins. They are what? Twins. They move together. Good. Then, on the other hand, if you see, cost of sales, maybe 1,000 Ghana, then the inventory figure given to you is the closing inventory. How we get it? So cost of sales and closing inventory too are also what? Very good friends. They are very what? Good friends. How we get it? Then fine. So that is it. Now let's see with this question. So I wish you can calculate it for me now. Okay, so revenue is there, 272,000. Purchases, 221. So once I see purchases, any inventory figure, whether they inform me or not, is what the open inventory. So inventory, this figure is the open inventory. It is what? Open inventory. That means the closing inventory will be given to you in a footnote. Let's go and see. Closing inventory note 2. Go. Closing inventory, here's it. So closing inventory must be in a footnote. So that is it. So here, if you want to get the cost of sales, you start open inventory plus the purchases plus the purchases. Purchases don't want to come over. Plus the purchases, and then less what? The closing inventory. Before you consider any other item, I'll be getting it. So this is your trial. In fact, I've solved it too. Right? Just try it. Okay. So that is it. Now I am done with the cost of sales. Good. The most popular one is the other section where you see the cost of sales in the trial balance, like the one that we have, the one that we are doing. But the examiner just said cost of sales and stock. They didn't say whether it's closing stock or opening stock. No date. But once there's cost of sales here, automatic, it makes this stock what? The closing one. How big get it? Because cost of sales and closing inventory too are also what? They are very good friends. And they are twins. They move together. And they're fine. Okay. So on that note, I am done with the first aspect. I'm going to the most important part. For that part, or this part, you have to do your seats. Then fasten your belt well. Make sure that you understand from here going, because we are now come to start financial reporting. What we are doing here, we're still at the basic level. We are now come to do financial reporting. Now, the footnotes that you are going to work with, I have grouped them into 3. So the footnotes, I have grouped them into what? 3. So first, but why do we call it footnote? It's called additional information. Additional info. So that the following additional information is relevant. It's also relevant. Now the footnotes, majority of them, if it is on its own, not all the footnotes are on their own. I will explain. The footnotes, if they are on their own, treat them how many times? 2 times. Either one leg will be in the P&L, and then the other leg will be in what? The financial position, or both legs will be in the P&L, and both legs will be in where? The financial position. So the footnote You have to treat it what? 2 times. Please. So that is the footnote. Now, I have grouped the footnotes into 3. Before that, some of the footnotes, you treat them one, just one, not 2 times. Why? They are the one that they are explaining things in what? In a trial balance. Maybe they've done one leg already, and they are telling you the other leg. So that means the item will be in a trial balance. If you have done one leg, it will be in a trial balance. And they will tell you that, oh, we did the one leg, so left with the other leg. So do it for us. So that will be one. So take note of that. Aside that, in fact, almost 90% of the footnotes must be treated 2 times. Almost all the footnotes must be treated 2 times. But if that note is not explaining a figure in the trial balance, then treat it 2 times. You are done. Now let's see. The footnotes, I have put them into what? 3. In fact, if the notes are 10, 20, 25, if I may give you 30 footnotes, it's composed of the following 3 items. 1, the composition of the footnotes. So the footnote comprises of 1, adjustment. I call some people adjustments. Adjustment. First one is what? First one is bad debts. Bad debts and provision for bad debts. The first one is bad debts. Bad debts and provision for bad debts. So at least either one or few of the notes will talk about bad debts and provision for bad debts. So we should know that. Some of the footnotes will talk about accruals. Accruals. And then if there's accrual to the twin must come prepayment, right? Good. So that's the first section. So some of the footnotes will talk about adjustments. I have 3 issues here. Then 2, item number 2. So item number 2 there. That one we don't have control over it. Errors. Maybe they've done treated some of the items wrong, and they will inform you that they sold motor vehicle and they've added a proceed to the sales, which is what? It's not true. If you sell motor vehicle, it shouldn't form part of the sales. Why? Because that is not what you do what in. Good. So we have to what? Reverse it. So for the errors, it means that we have to be versatile, or we should know how to treat a lot of items correct. For the examiner at his own discretion, pick any of them and then make an issue or a case out of it. So we should know how to treat a lot of the items correct, so that if there's any mistake that they've performed or they've committed on that item, you would see or realize and then correct it for the examiner. Good. So that is it. Okay. That is errors. Now let me give you a critical example of the errors. How do you treat dividend? Dividend. We've come across dividend. Dividend paid. Let's go to question 2. Question number 2. One of the notes set something. Good, it's here. Note 7, this very note, just the first sentence. They say operating expenses include an equity dividend of 12 million. Wow, operating expenses. That means they have added the dividend that they paid. They thought it's operating expense. So what do? They've added it to what? The operating expenses. So what's the operating expenses? Natural balance. Operating costs here. These operating expenses. They've added the dividend to it. So you know that dividend is not an operating expense because we've gone through the operating expenses and we came across what the dividend and we not treated it as operating expense. No, it's an equity item. So go to equity. Good. So that is it. Good. So when you realize something like this, quickly reverse it. They've added, so take it out. So how do you correct it? First, so step 1, reverse it. Reverse whatever they've done. So if they have wrongly added, reverse by subtracting it from that figure. If they have wrongly added, reverse it by what? Subtracting it, and vice versa. 2. After you have reversed it, do the right thing. Record it. Do the correct thing. So after you have taken the 12 million from where? From operating expenses, then let's do the right thing. Let's record it. Dividend is an equity item, so it must be subtracted from the retained earnings. Good. In the changes in equity. So that's the right one. So do the right thing or record it. Do the correct entry. So record the correct entry for the correct entry or the right entry. Or record it. So reverse and record. Reverse and record. How we get it? Good. So that is the error. So for errors, I can say that I'm done with errors. Yes. So that one, that's a win. And then the troublesome guy. The troublesome guy is the third one. I've grouped all the footnotes to 3. The troublesome guy. That most of us don't like it. But don't worry, you like it, okay? The IFRS. But the IFRS, that's the standard financial reporting standard. Some of the footnotes will be what? Standards. So in all the 10 footnotes, at least 4 of them or 5 of the notes, or let's say 6 of the notes will be what? Will be a standard. Error 1. Accruals and prepayment, also 1. Bad debt, also 1. Get the 10 footnotes. So get that across. By all, the IFRS will dominate. Why? In fact, the truth of the matter is that at this stage of in financial reporting, we don't use adjustment to disturb students because they are not difficult. So adjustment is not difficult. Prepayment, accrual, bad debt, they are not difficult at all. Unlike errors, they've done mistake. 2, the IFRS. So this is what examiner will depend strongly on to make his name. So that is it. So the errors and then the IFRS, they are the challenging one, not the accruals and prepayment or the adjustments. So this is student weak point, examiner's stronghold. Here is student what? Weak point, examiner's stronghold. But the adjustment, students like it. So that's student what? Stronghold, examiner's weak point. So that is it. Good. So now this is how I'll start the game. I'll start the game like this. Tonight, I'll try, or we will try together and clear the adjustments. So that next week, we are starting with the IFRS. Wow, that's good news. So I'll start by doing accrual, come to prepayments, and finally land on bad debts and provision for bad debts for the remaining time ahead of us. I hope you get it. Good. If you do have any question, kindly let me know. If you don't understand anything too, kindly let me know. So now let's start again. Kindly take just some notes down, few of them down, because these sections, they are not in the handout. Yes, these sections are not in the handout. So kindly take some few points down. Good. Now let's see. Accruals. Accruals. The underlying assumption, one of them is what accrual means. What does it mean? So the word accrual, what does it mean? And then in this sentence. So we are looking at accruals. That's right, all the possible names. We said that transaction must be recorded as and when they occur, and hence expenses must be recorded as and when you incur them, not when you pay, not at all. So as a result of accrual basis or accrual concept, you might end up owing, or someone might also end up owing you. Good. So accrual simple means owing. You're owing someone or someone is owing you. Are we saying yes, you can owe someone and someone can also owe you? Outstanding, left out for, unpaid. All these are the same thing. Left out for, unpaid. Good. All these are accurate terms. Example is what we saw recently. That is the interest owing is accrual. Yes, the accrual concept says that once you incurred it, please let it be in the book, whether I've paid it or not. Good. So that is it. Now, how do you treat it in the books? Let's start again. Accrual to all the accrual and prepayments, it affects two items. So let's see, I'll take the one after the other. Revenue or income. So it can be income, in fact, or revenue. So if it is income, it means that you've worked for someone, you've sold some goods to someone, you've performed some work, some service, but the person have not paid you. That person is doing what? Owing you. So it's an income to you, but it has not been what? Received. So that becomes on, like, receive that is not actually get the money. So that is it. So income that you've earned, not that is not like you have not worked for it though. No, that's not income. Income is what you have worked for. Good. But adding accrual to it, income that you've worked for that you have not received the money. So they are owing you. How do you treat it in a book? Two treatments. two treatments. Right? And first, the first leg, any of the income that they are owing, add it to the related income in the P&L. Add to what? Related. Add to related income. Add to related income. That is in the P&L. Bracket the P&L. Good. That's the first leg. Second leg. Is it a plus to you or is it a minus to you? If you work, in fact, you actually work for the person, but the person have not paid you. Is it a plus to you or is it a minus to you? If it's a plus to you, at least you can see someone is okay, which is somebody's owing, they'll come and pay me, so I get money, right? Good. So that becomes what? Asset. We add it to your current asset. So the same amount, add to what? Your current asset. See, no shortcut in exams. Take notes. So add it to what? Your current assets. Add it to your current assets. That's all. That is all. So let's cite example. For example, assuming that you've made a sale of 75,000. Total sale is 75. Out of it, by the end of the year, 15,000 of the amount has not been received. So this is the total sales. And then out of it, amount outstanding or owing is 15,000 by the end of the year. The whole year you made a sale of 75,000 in COVID period. At the end of the year, 15,000 of the amount have not been received. So they are owing you. How do you treat such? So the 75,000 will be given to you in a trial balance, and then we will inform you that 15,000 have not been received. Or we will give you the 60,000, the difference, and tell that okay, 15,000 have not been received. So how do you treat this? So once you've earned it, so here, first, what do? So in the P&L, when you record your sales, you tell the examiner sales, but I record a full amount, 75,000. I'll show workings. It will be 60 plus 15, right? That means if they have not received 15, they have received what? 60,000. So I'll add this 15 to the related, what I've received to get a full version, right? Good. So this is how much I've received. This is how much yet we received. And I'm done. Go to your financial position, the balance sheet. In the balance sheet, record current assets and write receivable or debtors or sales owing. Just that the sales owing have a nice name. So that's how you see the debtors or the receivable. Receivable, 15,000. So this be the recording. What if it's rent? If it's rent, we change just the name to rent. And yeah, also change it also to rent. Rent owing. Yeah, done. So that is it. So income that is not received is an asset to you or current asset to you. Good. We are done for the first section. Now, let me continue the game. Good. We are going to expenses. You can also have expenses what owing. So it's not only income that you owe, but most often it's the expenses. Most often it's the expenses. Because you not allow people to be owing you plenty like that. Always want to want your suppliers to give you a lot of credit or with when the bill become or payable for like. So now let's go to what I do at the end. Let's go to sorry, I'm feeling. Let's go to expenses. Expenses. So you can also have expenses. So that means any of the expense or the expenses they've not paid for, they are owing. How do you treat it? So that one too, as usual. In the P&L, add to the related P&L, the related expense. Related expense. Then B, you are owing expense. So, and we say owings are what? Liability. If it's an expense, so you add it to your liability. So you add it to current liability. Add to what? Current liability. That's all. A critical example is the interest owing. The one that we just saw, one I just realized. So the treatment, for example, so going back to the interest owing section, the interest owing section, you have, when you go to the P&L, add it to the related, you realize that you use interest expense here in our P&L, open a bracket, whatever you paid, they paid 14,000 plus what they owe. They are owing was 4,000. So that gives us 18,000. So that's why we had 18,000 as the finance cost. Just that there's a smart way to do this calculation. The same as you taking 18% times the 100. That's what we did. But indirectly, we have what accrued 4,000 to it. Good. Then left with what? The financial position. For financial position, go to current liability and record interest owing and put the 4,000 there. We are looking at how do you treat the part that you are owing, the proportion that you are owing. How do you treat it? You say add it to the related expense, add it to your current liability, then you are done. Good. I'm done with the expenses owing. I'm going to prepayment. Then we are done. Then we tackle bad debt. Prepayment. You are welcome. Prepayment. You are welcome. Prepayment. You are welcome. Prepayment. You are welcome. Please, let's try as much as possible to practice more. Let's practice more. Because if we don't practice, but these items, they are a bit good, but they will leave you right now. You don't practice them. Good. So prepayment. Prepayment. This occurs when you pay or receive funds in advance. You make advance payment. You paid it ahead of time. As at the end of the first year, you've paid for 3 years rent in advance. Good. So the proportion that you have paid it in advance as at that time, that's the prepayment. So you normally say that paid in advance, paid ahead of time. If I in 20, if I pay the financial statement for 2019, oh, you've already paid for 2020, can you pay for 2021, 2022, and so on. Oh, that's a prepayment. Good. Please, if you're supposed to pay something December, and you paid it maybe 2019 December, but you paid it 2019 January, is it prepayment? You paid it here. Yeah. You paid it here. Maybe you're supposed to pay 20,000 December. Right, so me, I don't want trouble. Let me pay it. So we gave 1 year interval or 12 months. So 15th of January, we gave them the money, 20,000 Ghana. So the question is, will it be prepayment or it's not prepayment? Anyone who will try for me? Anyone who will try for me? But most of you had it correct. But the issue is this. The question is, when are you preparing the financial statement? If you are preparing a financial statement, and most of the financial statement are at the year end, right? Of course, at the year end. Good. Let me keep. Now, when you are preparing a financial statement, as at December, you are preparing a financial statement as at the end of the year, so December. But then you paid it, so it's not prepayment. So it's not what? Prepayment. So I don't December, it's not prepayment. I'll be getting. If I prepare a financial statement after December, and that's the most case because you prepare a financial statement after the end of the year. So it will not be what? Prepayment. Even though you paid it in advance, but it's within the year. However, if I prepare a financial statement, let's say January, maybe you prepare it at January, then you can consider that as your prepayment because that payment you have to pay when? December, or you paid ahead of time. So that will be what? Prepayment. How we get it? Good. So that is prepayment. Great. So prepayment means as at the time that you are preparing the financial statement, and the line where it was as at the time, not when you pay it to, as at the time that you prepare the financial statement, have you paid anything ahead of time? That's a prepayment. How we get it? So at the time that you pay the financial statement, the end of the rent paid in advance. Good. Okay. Now let's see. No. Now let's start with the revenue first, or income. Revenue slash what? Income. So income is what you've earned, money that you earned. You've worked for it. Good. Just like here, income paid, received in advance. You've not performed the work, but they've already given you the money. I think it's not good though. You spend the money and then you now owe them a work or a service to do. So that is how do you treat it in your financial statement? The pre-orders, the customer have not received the goods, but you have asked the customer to make a deposit, and the customer have made that deposit, advance deposit. As at the end, when you're paying your financial statement, you're still not giving the goods to the customer, but you're taking the customer's money. That's what that's what revenue or income received ahead of time. So now the truth of the matter is that most of the income is not for the year. Like the example, as at December 2019, the whole of 2020 rent has been paid. So let's assume that January, January, the landlord managed for 2 years rent advance. So you make a year, you're supposed to pay, let's say, 10,000 for the office premises. So 10,000 for a year. So 2 years is what? 20,000. So the landlord asks you, in fact, on 15th of January, you hand over 20,000 to the landlord. You are December preparing the financial statement. What to be the prepaid version? The prepaid version will be okay. So if it's 20,000, 10, right? Yes, 10, yes, 10. The 10,000 for 2020, 2019 is 10,000. So it tells us that this 10,000 is the one that you paid ahead of time. So how do you treat this 10,000? So the question is this. Let me ask this question. This 10,000, is it for 2019 or for 2020? Who tell me? The 10,000 is for what? It's for 2020, but not 2019. So the question is, which of the financial statements are you preparing? Are you preparing 2019's financial statement or 2020? We are preparing 2019. So the cutoff point is where? 2019. We have to record transactions or issues that we have consumed. We've not consumed 2020, so we cannot include it. Even though you pay 20,000 to the landlord, please, 10,000 should not be bad. How do you get it? Let us know that you paid 3 years, so 2021, good. That means give the landlord 30,000 cedis. So it means that both 2020 and 2021 rent is not part of this year's own. So that is it. So how do you do it? So that means you have to subtract it because not for this year. The line where is what? It's not for this year. It's coming from the accrual concept. Transaction must be recorded as and when they occur, not when cash is paid or received. Good. This transaction that we paid for is not for this year, so it must be taken off. So it means that the entries will be like this, subtract it. So that's on the line where subtract it. So that's right. So first, subtract it from where? From the related words, revenue or income. Subtract from where? Related revenue or income. Now, is it a good news or is it a bad news to you? Good. You have received money. You have received money ahead of time. Someone have paid you. The work, you've not done the work, but you've taken the money ahead of time. Let us know that you are the landlord. You have received, now you are the landlord. You have received the 30,000 ahead of time and give them 3 years. They've only consumed 1 year. So if today you sack them, they have to hand over the remaining portion to them on the 20,000. So it's an asset to that company, but it's a liability to you, right? Good. So add it to current liability. Add it to your current liability. Why? Because you are owing someone a service to be performed. How we get it? You are owing someone a service to be performed. You are owing someone a service to be performed. So that is it. Good news. Now let's continue again. So that's the end of the revenue. Now let me quickly go through the expenses. Then we are done. So let's go to expenses. So expenses. Expenses paid ahead of time. That one's good news. So that are incoming time can be bad news. You paid and then taking it away. So expenses. You can also pay expenses ahead of time. So that one too, what do you do as usual? One, subtract from the related expenses, the related expense. Why? Because not for that year. Two, add it to current asset because that one is the plus for you. The guy have not performed the work, but you have what pay the guy in advance. That one, the guy owe you what a service. So that one is a plus to you. So add it to current asset. We are done. Good. So in short, there was a ringing tone. Say add all owings and subtract prepayment. So add all owings, whether expenses or its revenue. Add. So add all owings or accrual and subtract what prepayment. So prepayment. Good. That's the shortcut that we normally use. Good. I'm done with the accruals and prepayments. I have to back it with what? Illustration. So I'm going to back it with illustration. So after that illustration, then we are done for the day. Next week, we will look at the bad debt or the provision and the provision for bad debts. Good. So that is it. So kindly try this question for me. Question 3, note 2. Question 3, note 2. Question 3, note 2. So question 3, note 2. We did question 3. Good. So question 3, note 2. So kindly treat that one for me. And thank God we have the empty section of the notes, question 3. We'll be adjusting it. Then you'll be fine. So, good. So, now they are saying that, okay, but I like the solution. Oh, good. Perfect. So that is it. It's correct. Subtract from administrative expenses and add the same to the current asset. That's all. So now you go to admin. Admin expenses subtract. So that's the related expense. So it relates to what? Admin. So subtract from admin and add to current asset. So please let's go to our financial statement that we prepared. So admin expenses, where did we place it? We placed it in what? Operating expenses. So let's go there. So that workings that we did, let's go there. So kindly adjust it for me. So you go to operating expenses. When you mention the admin, you open a bracket. Admin was 33,000. So less 5,000. You get 28,000. So admin must be 28. Not the 33 that we keep in. Because by then we are just looking at where admin will go, not the adjustments. So now you know where all the items will be treated. So now they are going to now learn the adjustment, the issues. How we get it. Then 2, the current assets. You have to include what? Admin expenses prepaid 5,000 to balance 90. That's all. So that means the operating expenses will go down by 5,000 because of the admin. And that's the end of the game. So this is how you're going to do. You're going to treat it like this, and then By the time we finish the last note, then we pick the last balance, then we are done. Good. So thank you very much for coming. And this is how far the good Lord will bring us. On that note, we will continue again when we meet. But please, I have a humble suggestion. I want us to move faster. So what and practice more of the standard. I realize that we don't like the standard at all. So I have developed a strategy that you like it. This is a strategy to also save time. All the standard that you will have to go through, I'll issue the video out, arrange it for you. So you watch the video before we come to class. So that when you come to class, you are just come to solve questions. That's all. Okay, good. So that would be the strategy. Kindly subscribe to the YouTube channel if you have not done that. And then turn on the notification button so that you get notification to all our videos. Good. And then you can also join the class for your questions. If you have any personal questions to ask, join the main class and then ask me there, or put it through the mail and then I'll pick it and then respond to it. Okay. So good.